Hello everyone. I just decided again to jump in and discuss today the 10 years Treasury. So let me tell you why I've been really focused on this in the last few months. It's just because last year we closed on a deal. But before we closed on a deal, that was when the Fed said they were going to start reducing interest rates. So all of us were all excited that the Fed was going to reduce the interest rate. But guess what? After the Fed started reducing, I think the first reduction was half a point before they started doing a quarter of a point twice. And that was like 1 point. The entire last quarter of last year, that was what happened. So based on that, you will literally think that once they've done that, that means interest rates will drop. That's what some people assume, that interest rate was going to drop. But some people do not understand that it's not just about the Fed rate cut. The 10-year Treasury also plays a major role in how low the interest rate goes. So in September last year, the interest rate went down, especially when the Fed said they were going to cut down half a point from the interest rate. So it went down slightly. And the reason why the Fed did that was literally because the inflation was coming down. I think the inflation then was 2.1. So they decided that, okay, the economy is getting better, so they should cut it down. But the moment that happened, what happened to the 10 years Treasury? The 10 years Treasury started going up. We saw it from September, October, especially October, November, December. And we had a deal under contract. For those of you that are closing on deals or you know about loans, some agency loan like Fannie Mae loan, you don't close on it until a few days or a week to the closing. That's when you lock in your rate. So we're watching this unfold as the Fed was busy reducing rent and the 10 years Treasury was going up, was doing the reverse of that. So now the question is, what happened? Why did that happen? Why was one going up and the other one coming down at that time, and the effect? So the 10 years Treasury is really dependent on inflation expectations, not just inflation expectation, and also growth expectations. So this is how the 10 year typically works. When there is a sense in the market or in the economy that there's going to be inflation in the market, the 10-year Treasury tends to go down. But when there is an expectation that there's going to be serious growth, then the 10 years Treasury goes up. It's counterintuitive, right? Yes, that is how the 10-year Treasury works. It's about the market expectation, what the market perceives to be the issue. So when there's something, when there's like a deflation, the interest rates will go down. Like we're seeing that play out. In the last few weeks, we saw that the 10 years Treasury went down by 4 basis points. And that's because of what is currently going on. There's a lot of fear, uncertainty in the economy because of the job layoff, the tariff and all that. The economy, so people perceive that there might be some form of hardship and the economy might slow down. So that is the ripple effect on why that is happening. So when you hear that there's going to be a rate cut, don't just assume that because the Fed is cutting rate, that the rate is going to come down. It's actually the 10 years Treasury that kind of determines the interest rate me and you pay for our product and services. So now the question is the Fed chairman or is the Fed actually in control of the interest rate? I think that's a question for you to answer, because if the Fed is actually in control of the interest rate, that means if they are taking down interest rate, every other thing is supposed to conform to it. But really, that's not what we are saying. We are seeing the reverse, especially when there is a growth in the economy. And during the Biden administration, especially in the last 1 year, we all thought there was going to be some form of a recession, but we noticed that the economy was growing stronger and stronger. So that meant that interest rate was going to remain high and all that. So we saw that also play out during the pandemic. You see, the Fed was at 0 point and the Treasury was, I can't remember, maybe 2% or so during the pandemic. And that was because there was a lot of scare in the economy that things were going to go bad because the whole nation was on lockdown. There was no activity going on, supply chain, everything was at its zero and all that. So based on that, the Treasury went down. So my point here is that as investors, how do we prevent this kind of risk? Because now we know that the Fed rate cut and the 10 years Treasury are two different things entirely. And one directly affects us in the sense that depending on if there is growth or inflation in the market, that is what determines how up or how low it will go. Since we know that this is the case and we can't really forecast or say this is what interest rate will be in the next 1 year, what are the things that we can start doing as multifamily investors to mitigate the risk? Like I always say, we have the macro and the micro economy. For the macro economy, we really don't have any control over what happens. Things like the interest rate, what happens in the economy, natural disaster, political issues and all that, we don't have control over it. The only thing we can do is to try to mitigate the risk. So what are some of the things as multifamily investors that we can start doing to ensure that the effect of these outside strongholds do not affect our deals? Because at every point in time, you need to assess the market and see what the market is doing and know how best you can play the game and try to mitigate the risk. So as a multifamily investor, one of the things you should do is to fix your rate. So this is not the right time for you to be playing around with variable or bridge loan, because right now we don't know, interest rate has really been fluctuating too much that we don't even know where it's going to stand in the next 2 years. Although 2 years ago, remember, so for some of you that were underwriting deals or doing acquisition, we were told that from 2025 to 2026 that interest rate was going to go down. But here we are already in 2025, and that's not the case. Interest rate is still high. It's even higher than it was 2 years ago and all that. So anyone that is saying that they can really determine how interest rate will play out, that might not be the case. So as a multifamily investor, one of the things you want to do is to get fixed rates. You don't want the market to start playing around your deals and all that. You don't want the market to start doing that. So you need to fix your rate. This is a time for you to fix your interest rate. So the next thing for you to do is to diversify your assets around different markets. You don't want to tie down your assets in one singular market, because anything can happen. If anything happens to that market, it's going to affect you. So for example, if there's a natural disaster, let's say a state in Tallahassee or a county in Tallahassee, and all your assets are there, you should know that that affects you tremendously. So what you need to do is to diversify. Maybe you invest some in Tallahassee, some in Texas, some in Arizona and all that. You need to spread your assets into different markets. And if you're not investing in multifamily and all that, if you're just investing in the stock market, you need to start thinking of putting some of your funds in the multifamily deals. And if you're just investing in 401ks or IRAs, you might want to start thinking of diversifying your portfolios into putting some into multifamily, energy, oil and gas and all that. You might need to start thinking of doing that right now. There's a real significant effect on rising interest rate that determines the cash flow of the property. So this is a time for you to start investing in value add strategies. So you're looking for investment that will give you value add strategies, things that can improve your base rent, not just your base rent, that can also give you other income apart from your base rent. So you need to start looking for value add strategies, things like maybe reserve parking, maybe things like if you're paying all bills, like all your utility bills, you might need to start doing ROBs, that is the tenant to start reimbursing you back for the utility bill. So you just need to look for value add strategies, things that you can use to increase income on that property, because the effect of this interest rate is mainly is going to reduce your cash flow. It's not just only going to reduce your cash flow, also the debt coverage ratio. Most deals might not pan out due to the interest rate. So this is a period for you to start looking for deals that have value add options or strategies so that you can be able to increase the rent and increase your cash flow, because really interest rate might have taken bulk of your deal. So for example, last year when we closed on that deal, because we underwrote the deal very conservatively, we underwrote it at 7%. So when the interest rate was just going anyhow, we actually closed the deal at 6.8%. So our underwriting told us that we were very conservative, and even with the increase or in the shifts in the market, we knew that we're still going to cash flow on it. And besides that, the property we bought was a value add strategy. We already had a business plan in place to bump up some rents, because the market survey that we did told us that it's possible for us to increase rent because the market had already gone up, but that property, most of the rents were below market. So the value add strategy for us was to do some little renovation and increase rent. And not just that, we noticed that they were not doing some things like reserve parking, they were not doing ROBs, they were not doing all that. So these are part of the things that we said we're going to add up, and these things are very significant because it can increase both the base rent and also other income, and will improve your net operating income. Don't forget, the net operating income is what determines the value of a property. As long as you are able to increase the income of the property and reduce the expenses, that will make your NOI go up. And once your NOI goes up, then the value of your property goes up. Another thing you need to do is to focus on strong tenant base. So aside from the interest rate, we also saw the immigration, the new political, aside from the interest rate, another thing that's affecting some multifamily locations or businesses are what Trump said about the immigration, that was going to deport a lot of people. Like I said in my previous videos, the people that is deporting are people that are staying on your property or my properties. They are not just random people staying on the bridges or on the street. These are people, real human beings staying in apartments that you own or I own or other people that we know own. So this will also have a significant effect on you. So one of the things you want to do is to ensure that your property management company focus a lot on the tenant base. You need to build a strong tenant base. So as we close on that property in December, what we are doing is to remove those tenants that have not been paying rent. We're taking time out to sweep out those bad tenants and to fill it up with good tenants. So you need to take time to ensure that you have a strong tenant base. This is the period where you need that in order for you to increase your net rental income. Another thing you want to do in order for you to mitigate the risk is also for you to do thorough due diligence. I cannot overemphasize on thorough due diligence. And like I said, you necessarily don't have to do the deal. If the deal does not work, that's the door. Take the door and go, So thorough due diligence is important. It's going to help you unfold many things. And it's up to you to now take the decision. Do I want to continue with this or go back on it? But we see some people have this emotion around a deal and all that. And if you do that, it might go the other way and all that. So thorough due diligence is important because the main purpose is for you to unfold the cankerworms and for you to know if the cankerworms are manageable or they are not, or it's left for you to walk away or go on with the deal. So these are things you need to start looking at and start considering. The last point I want to talk about is flexible business plan. I always tell people, yes, at the beginning, it's important that you create your business plan, but it's not supposed to be cast on stone. You need to have a business plan that is very flexible. And that is because so that it can adapt to the market condition. So for example, if you have a business plan that keeps you locked in for so long and all that, you might need to consider having a loan term that is fixed and also flexible that you can exit if the market conditions are good. So for example, if the interest rate drops in 3 years, if you have a loan debt or a loan quote that helps you to exit in 3 years and is fixed, I think you should go for it. Like for us last year, when we closed on our deal, that was a loan package we used. It was a 5-year fix, but it's very flexible that we can decide to exit after 3 years and all that. And it's a fix. So we're able to use one stone to achieve two birds. So you need to have a business plan that is flexible, that you can easily pivot. It's not supposed to be just one way. Because if anything happens, how do you mitigate the risk and all that? So your business plan should accommodate some form of flexibility, especially in this market or in this economic or political economic situation or market that we currently find ourselves in. Yeah. In other words, the bottom line here is for you to understand that when the federal government is cutting rate, it does not necessarily mean that interest rate will go low. So you need to remember and consider that. The effect or how interest rate can go low is just based on the inflation and growth expectation of the market. So as an investor, it's not just for you to sit down and observe. You need to also understand the market trend, inflation expectation, growth expectations. There are many information out there that you can gather all this from and know exactly where the market is trending and for you to know how you can mitigate this kind of risk. I hope this was very useful to you. So I just said I need to jump in and discuss a little about the 10-year Treasury because some of us have had the misconception that the 10-year Treasury is just for you. I mean, once the Fed says interest rate is going up, we're all excited. Oh, interest rate is going up. We don't know that. Another thing that plays a major role is the 10-year Treasury and all that. Forgot to mention that the CPI report plays a very strong role on how the 10-year Treasury play out in the sense that will determine how strong the market is or how weak the market is at that point and all that. I hope this was very useful to you. Please have a wonderful day.